Okay, so hello and welcome to our latest urgent market update video for Friday, the 19th of July. I hope you're keeping well. Thank you very much for joining us. As you can see, the title for this video is Weakness in AI Tech Stocks. Will it continue? The reason why there's such a focus on the micro is because they're having such an influential impact on the macro dynamics. So let's break this down for you and we'll explain it in a little bit more detail. We should probably conclude this in the next 10 minutes. So let's start, of course, as we always do with our risk warning. Just take a brief moment to familiarize yourself with our risk warning currently up on screen, and feel free to pause this video if you need. Okay, so let's get straight into it then. What I would like to begin with is a little bit of an overview of the narratives that are likely to drive prices, and more importantly, this risk on, risk off narrative. So what are some of the things that we discuss on a regular basis with our traders every single day? Well, a lot of it is around central bank monetary policy decision making, and specifically the words from Jerome Powell, who's the Fed chair, have been really quite dovish in nature. So there's this expectation that the Fed are going to start cutting rates. And we've been in a bit of a rate pause now for quite some time. And there's every expectation, in fact, you could argue that the markets have been pricing in this dovish Fed expectation now for comfortably over a year. Now, we're yet to see a rate cut, but the market is anticipating that the Fed will be cutting rates. Now, it looks as if, and I'll bring this chart up on screen so you can see it in a little bit more detail, that there's an expectation for the Fed to start cutting rates in September. So for that, we'll bring up the CME Fed Watch tool, which is quite a useful tool. And if we scroll down, so just on the top left-hand corner of the screen, the 31st of July, the markets are not really pricing in any form of rate cut at all, so keeping rates at hold. So that's the expectation. Now things begin to change significantly in September. You can see we've shifted. There's a 1.9% chance that we'll actually hold rates at 5.5%. We're more likely to reduce and to cut rates 25 basis points. The likelihood of that outcome is 93.5% from a market expectation perspective. If you go back a week ago, prior to CPI, we were down at 70%. So we have been edging higher for a rate cut in September. Just to let you know, are we likely to see a further rate cut? It's more than half. So 57%, the markets are pricing in the best part of 2 rate cuts, and things start moving lower from there. So the market is fully pricing in 2 further rate cuts this year, despite the election in the US, which is really feeding into this rate pivot narrative. Now, there's also lots of discussions around soft landing. The economic sort of backdrop is broadly quite positive. Now, you could argue we've been in a dynamic where bad news has been good news for markets, and that has been the case, but that's because of the dovish Fed rate pivot narrative. These things can get quite complicated and convoluted, so do bear with us if you can. We do appreciate that is very much the case. But we've got this new narrative that's been coming to the fore in the last few days, and it's really around this AI trade. So on that note, let me take you, and it's probably worth looking at NVIDIA, which has been one of the most publicized rallies in global equities anywhere in the world. And you can see the rally since 2024. We have had a share split, of course, but we've rallied exponentially. So we reached the peak of $140. We kind of pulled back quite aggressively, and then we'd gone through a period of attempting to make new highs, but actually subsequently failing. And it's this little, if I zoom in a little bit more, it's this period here in the last 4 candles where we started to not just roll over to the downside. You could go 6 candles back actually and see a bearish engulfing candlestick, and then you see the rollover start to kick in. We gapped down, rallied down to the 120 level, Yesterday we kind of popped a little bit, but now look at the pre-market. We're expecting further weakness, and that's really important in terms of when I look at the US indices in terms of translating that information. Now, it's a bit of a mixed bag. We've also got this dynamic with Microsoft at the moment, which I shall share with you now. There's been a sort of an IT sort of global IT problem with I think Microsoft servers, something to do with cybersecurity and some sort of update from some kind of security related update within the system. So we have seen in the last few days, we've seen weakness as far as Microsoft share price is concerned. And these are all your AI stocks. So we're seeing some capital seemingly come out of these large cap AI stocks. The reason for that could just be purely a little bit of profit taking. It just makes sense to take profits after such a massive rally. So we might just be seeing a little bit of profit taking. There's nothing really in the market fundamentals that can shift the narrative significantly. We don't think the wheels are likely to come off, but we are expecting these markets in the New York Stock Exchange to actually gap lower and put a bit of weakness. Certainly with the IT issues this morning, there's airline have grounded airplanes, airports shut down. It's not just confined to airlines, it's also banking. The LSE had a problem this morning, and further industries as well. So different geographies, different industries are all kind of impacted by this. Now, the fallout of this is going to be really interesting to see how these markets react. So the expectation is for on the pre-market for some of these AI stocks to actually weaken. Just to play devil's advocate, we're not necessarily likely to see that weakness across the board. You can see like Apple is expected to kind of gap up. So we've got a bit of a, not gap necessarily, but open higher and potentially rally. So this AI trade has been really profoundly at the center of these markets for the last year and a half. We've seen a profound risk on trade. That means indices higher. We'll sort of remove a weaker dollar because we've only seen a mildly weaker dollar in certain situations, not so much in others. We've seen bond yields lower eventually, and we'd probably keep the commodity market out of it as well. We've got gold at all-time highs recently in the last few weeks, last few days really. So we've had this AI rally at the fore. Now the question that we're asking ourselves is, will this AI rally continue? Because if it doesn't, what we're likely to see and what we have seen is money come out of the AI stocks and move into the broader sort of market dynamics. So a good place to kind of see that happen in real time would be in markets like the Russell 2000, which is it's a market that will accurately kind of showcase where a lot of medium capitalized companies fit in the overall view of these market dynamics. So we have been much higher, and the comparison between the Russell, for example, and the Nasdaq and the S&P is pretty stark, and we've seen this little rollover. So we're now beginning to see the risk-off dynamics feed through these markets. But looking at the previous 4 trading candlesticks prior to the last 2 days, you've seen an outsized rally in markets like the broader market dynamics. And that's what we refer to as the rotation trade. So just to conclude, we have reason to adopt a bit of a risk-off view like we have over the last couple of days. We've been able to benefit from some good trades, and there's still potentially more in the pipeline. We'd be looking for a weakness across the indices, not just in the indices, in the US indices, but also in the Nikkei and European stocks as well. We'd be looking for strength in the dollar. We've been able to add euro dollar and pound dollar this morning. Bond yields squeeze higher. We have seen a little bit of an uptick in US bond yields, so that fits into the overall dynamics. And there's every potential to see commodities like copper and crude oil potentially sort of roll over a little bit. So the question is why and what's the narrative? Well, it's got very little to do with kind of the expectation for the Fed to actually raise rates. Inflation is slowly coming down. There's no sign of hard landing or any kind of recessionary fears to any great extent. So we're left with this rotation trade away from AI. And historically, when you look at risk on, risk off, you'd see a risk on trade where capital would move into equity indices, and it would move into safe havens like the dollar, the yen, potentially gold as well. But now what we're seeing is a different contrast. So a safe haven seems to be coming out of AI and rotating into the broader market equities. So it's still risk on because the market fundamentals are very much risk on, but it's moving out of one subclass or some asset class, and it's moving into others. And we're seeing that play out. The question is, will it continue? Now, we've got this sort of risk on fundamental dynamic, really. We've got inflation coming lower. We've got unemployment ticking a little bit higher, which kind of gives a green light to the Fed to start cutting. We've got broadly relatively positive economic data. So it's all feeding into this AI narrative. So the question is, will this rotation, will it continue? Will we see these AI stocks continue to roll over to the downside? We think that's probably a likely outcome on a short-term basis, but it's actually quite a bullish view over a sort of medium term. So what we're saying with these markets is, if we look at, again, I'll just bring up NVIDIA. What we're saying is that we are absolutely experiencing a little bit of weakness in some of these markets. And although we might get more weakness, I think the overall fundamentals are still proving quite positive. So the opportunity to buy these markets in the not too distant future is a very real one. So translating this into potential decision making to try and capitalize on what these markets are doing, we have a very risk off, as we've explained, risk off view of these markets due to this rotation trade away from those select, very narrow, we're talking about 6, 7 individual equities which are having this pull down impact on your global indice markets. And although it's kind of pulling back off the lows, we do anticipate perhaps by weekend and certainly going into early next week, we're very likely to see further downside. Now, that will change if the whole AI narrative begins to change. But as far as the S&P, NASDAQ, Nikkei are concerned, we expect further downside. As far as the dollar is concerned, we expect the euro dollar to, at least on a short-term basis, make more progress lower. Same with the pound dollar. And with a stronger dollar, we'd expect a bit of weakness in gold as well. So that is our bias. It's for further downside. We're currently experiencing a little bit of a bounce as we look at these markets. However, we think there's every potential for this risk-off rotation away from artificial intelligence into other still risky assets, but we're clearly seeing the weakness in the AI stocks pulling those global indices lower, and very likely to do so more so on a very short-term basis, with the potential for the dollar to strengthen quite considerably, and we are seeing those bond yields tick higher. So this is the narrative of focus, really, and it is more so now to do with AI than perhaps other sort of market narratives which we could be discussing at this particular point in time. So I hope this goes some way to explaining what is quite a convoluted market dynamic. It's quite unusual in many ways. However, it is likely to present some fantastic opportunities. So hopefully we've made some attempt to try and explain this as best we can. Of course, you might have some questions from any of the from what we've been discussing in this short video. If so, do feel free to drop us an email at support@livetradesroom.com, and we will get back to you as soon as we possibly can. So on that note, thank you very much for joining us. Do stay tuned for our next video. And if you are interested in learning how to trade, you can access one of our discounted live trading and education bundles on the website. It just starts with just $59 per calendar month. So hopefully you'll find it good value to acquire a really good education, not just educated in terms of the theory, but more importantly, the practical and being mentored on a day-by-day basis. So that's what we offer. For more information, just go to thelivetradesroom.com. And all that's left for me to say is thanks for joining us, and we'll see you next time. Bye for now.